Okay, so apparently we are in a Sigma 3 level super bubble right now. We'll talk about that as a continuation of the 2022 housing market predictions. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is I don't even know, 25th of January. The month's almost over. Things moving quick. Randy Patrick here, putting the realism back in real estate. Hope you are doing well. So yes, we're going to start to talk about financial things that not everybody can easily understand. It is a lot to go through, and it's some difficult terminology I've been learning over the past week or so. But first of all, hey, you know what? If you're looking for distressed property listings in your neck of the woods, jump on gethousingdata.com. That's gethousingdata.com. They are my partnership with Foreclosure.com, and basically the number one provider of distressed property listings across the country. So check it out. They actually have some pretty good information there. Free trial as well, too, so you can see what's happening in the distressed property world in your location, and you can verify what's happening with the world. So we're doing video number 3 of the housing market predictions for 2022. Everyone likes to predict stuff, and I do as well. The whole point, though, is really a best guess, is to see what the numbers are saying, what the economists are saying, what the investors are saying, what the world is saying, and seeing if we can figure out how to navigate this truly sort of crazy housing bubble and market that we are currently in right now. And of course, people, it's like, what are we doing? Well, this is really the first U.S. bubble extravaganza. This is the article we're going to talk about. Housing, equities, bond, and commodities. So that's really what the focus is today, which is actually kind of interesting. So the whole point, I found this article doing a little research, and essentially, the guy's name is Jeremy Grantham, and he's an economist, and he's obviously got his own firm and does such of stuff and consults and looks at all these financial models, equations, and whatever. And basically, his perspective here is the fact that we are in not only a bubble, but we're in super bubbles. So essentially, the bubbles have grown so large that I guess there's a classification statistically for the bubbles. And I guess here he says, executive summary says all 2 sigma equity bubbles in developed countries have broken back to trend. But before they did, a handful went on to become super bubbles of 3 sigma or greater. So I guess the term, this 2 sigma, 3 sigma is literally a term used in, statistical analysis. And that's, I think it's a bit of a, almost like a probability as to how intense the bubble could be and et cetera. So regardless of what the bubble is. So basically in the U.S., we had bubbles in 1929 and 2000, in Japan in 1989. There were also super bubbles in the U.S. housing the market in 2006 and Japan in 1989. All 5 of these super bubbles corrected all the way back to trend with much greater and longer pain than average. So yes, bubbles can be painful, especially when they retract or crash. Today in the U.S., we are in the 4th super bubble of the last 100 years. So I guess that's the whole point, is that these bubbles come at certain periods of time, and the larger the bubble, the more frequent over the period of time is what I guess how they're figuring out what the sigma 2 and 3 stands for, I'm assuming here. So essentially, it's kind of it. Now, this information, I guess this article is really going to be it's interesting. You need to read it. The link will be in the information section, so definitely read it. But a lot of it is a critique. It's critical of the Fed for obvious reasons. The bottom line is that in general, the bubbles in multiple assets, not just equities, have continued to inflate, and therefore the potential pain from a break has increased. So if you start reading through this, I'm just going to give you some of the points here, because again, it's better if you read it and a couple times as opposed to me just spewing it out here. So today in the U.S., we're in the 4th super bubble. Previous equity bubbles have had a series of distinct features that individually are rare and collectively unique to these events. In each case, these shared characteristics have already occurred in this cycle. So what he's basically saying is that we're in the super bubble scenario, and we're kind of already there. It's not happening. We've just got there. And that to me is concerning, because, typically, there's other we'll call it industries or verticals or sections of the economy that can withstand, some of the carnage if something falls apart. But now we're in a situation where it's along more markets, more groups. So we've defined investment bubbles at their firm over 20 years now as a statistical measure of extremes. All right. So basically, what he's saying is that you know, we've had three. It was, and so it was in the three great bubbles in the U.S. assets and equities in 29 and 2000, and in housing in 2006. So basically, all these in Japan's bubbles, all these bubbles fell all the way back to trend. So essentially, we're saying bubbles increase, they get big, they pop, deflate, and they come back down to reality, come back down to earth. So he talks about what the definition of a 2 sigma bubble is. Like, I guess it's so many outliers after so much time, and 3 sigma is more of that, I guess. Ultimately, in the end, here it's basically the higher you go, the lower expected future return. You can gorge on your cake now or enjoy it piece by piece in the distant future, but you can't do both. The higher you go, the longer and greater the pain you will have to endure to get back to trend. So yeah, the higher the bubble is, the harder the crash for sure. And so that's sort of bubble theory, which we talk about quite often in real estate. But when you start really looking at this, it's more of a first time in the U.S. we have simultaneous. Whoop, that was too fast here. First time in the U.S. we have simultaneous bubbles across all major assets. So this is what's really concerning this economist. He's kind of going, hey guys, I mean, we've got it here, we got it there, but now we have it everywhere. And that can cross pollinate, that can one crash or one change can reflect and push into other assets and cause chaos as well too. So he says for the first time in the U.S. we have simultaneous bubbles across all major asset classes. To detail. First, we are indeed participating in the broadest and most extreme global real estate bubble in history, which I do agree with here. Today, houses in the U.S. are at their highest multiple of family income ever, after a record 20% gain last year, ahead even of the disastrous housing bubble of 2006. So yeah, we've jumped like you wouldn't believe from 2006, and we'll talk about CaseShiller because that came out as well too in a second here. But we're at the highest multiple of family income ever. So in other words, home prices versus income, we're up there, okay? But although the U.S. housing market is selling at a high multiple of family income, it is less and sometimes far less than many other countries like Canada, Australia, the UK, and especially China. And in China, real estate has played an unusually important, unique role in the extended boom and thereby possesses an equally unique risk to the economy and hence the rest of the world if its real estate market loses air exactly as it appears to be doing as well. So, yeah, I haven't even mentioned China yet, but I've done a lot of research on it. And, there's some very, very large property development countries there, companies in China that are, I guess you could say, collapsing as we speak. Not just one. Everyone's heard of like Evergrande or Evergrande, however you pronounce it. Definitely some major stuff going on there, and a lot of it is, there's other ones as well too. Evergrande was like the second biggest. There's another one. There's a number 3. They're all having massive issues in China, and that will probably have permeating effects across the world because ultimately it's going to happen. A lot of the bondholders for Evergrande, for example, that are international, they're going to get wiped out. Right, because typically, like kind of the U.S. did back in the last housing crisis, they did the TARP program, Troubled Asset Relief Program. Well, essentially, the government steps in to bail out. I'm sure the Chinese government will bail them out as well too. So really, they're going to bail out their own people, their own internal issues. Outside investors are going to get killed. So simple as that. Second, we have the most exuberant, ecstatic, and even crazy investor behavior in the history of the U.S. stock market. In his opinion, the greatest buying ever to the idea that stocks only go up, which is surely the real essence of a bubble, which makes sense. Third, as if this were not enough, we also have the highest priced bond markets in the U.S. and most other countries in the world, and the lowest rates, of course, that go with them that human history has ever seen. So there's a big divergence there. And fourth, and he calls it as gravy, as if we need any. Basically, broadly overpriced or above trend commodities, including oil and most of the important metals. In addition, food prices at all-time high. Ultimately, we know inflation's up and everything is costing a lot more money, whether it's lumber, concrete, building materials, food, gasoline, whatever. So it's going up big time here. And so that's almost like 3 or 3.5, he calls it, 3.5 things across different asset classes that really would be of concern to any economist. But now we have all 3 peaking and really having some problems here, and and having the inflationary issue come up as well does not help, and that's probably going to push it all over the edge. So ultimately, in the end, what they're saying is that, hey, guys, I mean, something's got to give here. And, I'm not really, again, you need to read this. I'm not going to read it all, but you can see that he's critical of the Fed. He goes back in time to, they wrote and were already critical about the Fed back in 2007 with deflating house prices. And basically, it's kind of like what he's saying is that, all these major bubbles are popping up, but for whatever reason, the Fed, doesn't seem to be noticing this or considering this. They just keep printing money, keep messing with rates, keeping rates lower, quantitative easing back over the years. Yeah, now we're going to see some rate increases apparently. But ultimately, a lot of other economists have said the Fed has mismanaged the housing market for sure. And now we're going to see this and, 2 or 3 other, markets or asset classes have problems as well. And again, the Fed is barely noticing the warning signs or choosing not to notice them, I guess is really what he's saying here. So, where does this end up? Well, if you look back in the last housing crisis, a lot of stuff happened and a lot of people got hurt by it. And, it started a number of other issues in the economy. Where we are today, it seems like there's other things that will have their own issues without any help from the housing market. And that's kind of, a scary thing. So bubbles, growth, and inequality, I guess really they're talking about here. So here we are again, this time with world record stimulus from the housing bust days. So of course, we've had quantitative easing and low interest rates that stimulated the housing market growth, followed up by an ineffably massive stimulus for COVID, some that, of course, necessary, but just how much to be revealed at a later date. But everything has consequences, and the consequences this time may or may not include some intractable inflation. But it has already definitely included the most dangerous breadth of asset overpricing in financial history. At some future date, when pessimism rules again, as it does from time to time, asset prices will decline. And if valuations across all these asset classes return even 2/3 of the way back to historical norms, total wealth losses will be in the order of $35 trillion in the U.S. alone. So that's some pretty big time pullback if there's going to be price declines, right? If this negative wealth and income effect is compounded by inflationary pressures from energy, food, and other shortages, we will have serious economic problems. Well, you know what? I think we're kind of there right now. I mean, I'm seeing the effect even down here. Obviously, gas prices are high. Prices are higher for everything. Stuff that I before, that you buy at Costco or discount stores, they're pricier now. When you do grocery shopping, we're really noticing the fact that there's less and less on the shelves. It's not like the shelves are bare, but the shelves are getting picked over pretty quick. So that means people are starting to hoard, or they're buying because they need to buy. They want it for a period of time. We haven't seen. I haven't seen the toilet paper shortages like COVID at a Costco lately. But when you start shopping, you start to notice these things. You're like, hey, not as much choice, and they're not stocking their shelves as much as they used to on a daily basis here. So something's obviously happening with inflation and what we see in the retail sector for sure. So again, how does this affect you and I? Well, it basically is the rules of bubble reviewed for distracted readers, which certainly is me. So all 2 sigma equity bubbles in developed equity markets have burst all the way back to trend. The U.S. reached the 2 sigma level in summer of 2020. So basically, we're already at 2 sigma on the equity side. It's getting bigger. But some of them went to 3 sigma or more before they burst, producing longer and deeper pain. The U.S. reached 3 sigma, the designation of 3 sigma bubble, in late 2021. Timing is uncertain, and when you get to a 3 sigma super bubbles, such as we have now, there are a few examples, but they've all shown certain characteristics before they broke. So ultimately, in the end, we're kind of at that position now that we are so bubbly on every asset class out there. We have a negative, negative economy happening right now with inflation, etc. So that's concerning people. Lots of unemployed workers still. We have still people not paying rent, people not paying their mortgage. There's a lot of stuff behind the scenes that's causing a lot of this chaos right now. And ultimately, it boils down to, for me, so when you say, what's your prediction, Randy, of some of this? Well, my prediction is something's going to happen in one of these asset classes. And when it does happen this year, it will affect the other classes. That's just the way it normally goes, right? So ultimately, in the end, it's kind of like our economy is propped up, manipulated, propped up, etc. Something's got to give. And, whether it's, bonds or equities, who knows, or housing. I mean, we all know that housing is peaking beyond peaking, and people are just getting tired of it right now. So obviously, my channel talks about housing, but I'm not an economist, and I can't really get into detail. Put it this way, I'm not the guy to get into detail about equities and bonds and stuff like that. I mean, I do understand it, but I'm not certainly I don't think educated enough to speak eloquently and effectively on that. But from the housing perspective, it really just needs something to trigger the flow the other way. We are a manipulated marketplace. You can't say we're not. We are in a bubble. You can't disagree with that. We're at the highest we've ever been. We're starting to see some deceleration. Again, the deceleration of appreciation is happening now. We'll talk about that in the next couple slides here. We haven't seen the effect of any of the forbearance, foreclosures, stuff like that. That just hasn't been available to affect the marketplace right now. So all that is actually going to start, and that could be the trigger. Maybe we start to see extra inventory, some distressed properties come to the market, some more foreclosures come in. That might change some of the dynamics of the housing industry, and we'll see how that plays out. But something's got to happen here, and whether it's a whole social revolution where people just go, I'm not doing this anymore. We see this happening now in various states and cities across the country, where whether it's new legislation or executive orders, or people just refusing to comply or pushing back on laws. I mean, I think everyone's had enough of pretty much everything. So it could be just something where people go, we're not buying anymore. We're not paying these prices anymore. We're going to find alternatives here, or we're going to wait it out. So eventually, sellers are going to sell, and the sellers need to sell will have to drop price and accommodate the buyers and where the buyers are at. It's pretty straightforward. All right. Now we shall move on. Oh, and first of all, if you're not, or second of all, if you're not a subscriber, if you could please help my channel grow and smash that subscribe button, I'd really appreciate that. And if you think you're a subscriber, could you please double check and resubscribe? Meaning, people have told me that they're not a subscriber anymore. They don't get notifications, etc. So stuff does happen behind the scenes in my channel. So if you could resubscribe, and that would be really, really appreciated, and I would thank you. And again, as I said, appreciate everyone's patronage and views, comments, etc. So I really do appreciate it. So every so often you get kind of low and kind of down when you see the results of your videos, and you're getting controlled or manipulated as well. So I'm doing some stuff to hopefully get this back up to a little more resurgence. But a lot of it too, I'm focusing now on the real estate business, less on the videos. It's just the nature of the ball game here, guys. So let's talk about what also happened today, which is the last Tuesday in the month. And when we have the last Tuesday in the month, we have what? CaseShiller Home Price Index. So there we go. So CaseShiller is out. CaseShiller runs 2 months behind. So even though we're in January, we're talking about November data. So what we have here is the fact that it looks like an annual gain was 18.8% from a year-over-year perspective. That's annual, obviously, down from 19% the previous month. Top earners were Phoenix, Tampa, and Miami had the highest year-over-year gains. We'll talk about that as well too. But I guess the whole, you'll start to see some information now and stuff, some other news reports that we are so appreciation is decelerating. Okay, so it's kind of weird. Like, I'm still appreciating, but the pace at which we are appreciating is going less and less. So it's decreasing. So obviously, we have previously suggested that the strength in the U.S. housing market is being driven in part by a change in location preference as households react to the COVID pandemic. That's pretty much what they've said for the past 2 years now. Also, in short term, meanwhile, we should soon begin to see the impact of increasing mortgage rates on home prices. So obviously, as mortgage rates move up, as the Fed raises them, that diminishes buying power. So I predict that people will start to, homeowners are going to have to drop price to accommodate that. That's for sure. As well, we'll probably see more homeowners start doing cash out refis or HELOCs now, just because, if rates are going to go up, people want to pull money out before that really happens. And the first video I did was on the massive, equity withdrawal that could be happening this year. So we're going to see a lot of that stuff sort of playing out on different levels here. But ultimately, in the end of the year, it's been the same old thing for how many months now? Phoenix has led all cities for home price appreciation on an annual basis for the 30th consecutive month. So we're basically looking at 2.5 years here, Phoenix has basically led the nation in appreciation. Now, funny enough, though, what we don't talk about, we don't hear. So, for example, someone I know who locally here now, but was from the Phoenix marketplace, just gave me a text the other day saying, "Hey, talk to a title company in Phoenix area, and they're processing a ton of foreclosures now." So it's those type of things that of course I called and asked, and we chatted about it. But the whole point is that we don't hear some of these things right now. So we're at the cusp of it. I know we've been waiting for a long time. It's almost there, guys. Okay, we're going to start to see some changes as the months roll through here. So obviously, this is the indices, being tracked here, and you can for annual appreciation on a monthly basis. You can see at the top here we've hit the 20%. We were kind of down a little bit, at the very right of the graph. So we see a little bit of slowdown here. If we actually take a look at where we are, so clearly in the middle hump in 2006 and 7, that's our previous housing high water mark. Obviously, the trough in 2012, and we're top right hand of the graph. You can see that all the indices, the national, the 10 city, and the 20 city composite index for home price appreciation is up, and certainly over the past year, that's not a linear growth. That's more of an exponential growth as opposed to linear. So that's what's been happening, and various factors for that, which we all know about. Where are we with respect to where we're benchmarked from 2006? Well, we are now 49.6% from the peak, almost 50%. So the peak on the national index was back in July 2006. The trough, which is like the worst part of the house price cycle, was back in February 2012. So if you were buying property in around that time frame, you've done really well for yourself. Okay, you've probably doubled your money. So you can see that we're 49, so it's over 100% on all indices from the trough, and from the peak, it's almost 50%. So, again, if you called it a bubble back in 2006, you can call it a bubble now. People aren't calling it a bubble now for whatever reason. I don't know why, but you can spin it any way you want. I don't care. I don't care anymore. As I said, I know where things are going. I know who I speak with. I know what they say. I know what their business models are. I know what they're doing and the opportunities that are coming our way. So the whole idea is try to get to the distressed and have that match with the retail buying, and there's your spread in the middle. So that's the whole point to all this. Now, if we take a look at individual cities, interesting enough, we'll go through them now. So Atlanta, 21.6%, Boston, 13.5%, Charlotte, 22.9%, Chicago, 11.6%. Chicago has maintained some pretty good growth for having a ton of issues of people leaving the state, high taxation. And listen, there will be an enormous amount of pre-foreclosures. Well, they're there, and they'll be growing, that hasn't even been realized as of yet. Cleveland, 14%. Dallas, 25%. Denver, 20.1%. Detroit, 14.4%. Las Vegas, 25.7%. LA, 19%. Miami, up at 26.6%. They're the number 3 this month. Minneapolis, 11.2%. New York, 13.8%. New York, another state that's going to have significant amount of pre-foreclosure activity. I think my last video I showed a quick headline of an article about 14,500 people who are seriously delinquent, or homes or properties, mortgages, seriously delinquent on Long Island itself. So that whole Connecticut, New York state, around the city, Long Island, New Jersey, Philadelphia area is going to be a massive volume of pre-foreclosure activity. So watch out for that. Phoenix as the number 1 at 32.2%. Portland, 17.4%. San Diego, 24.4%. San Fran, 18.2% increase. Seattle, 23.3%. Tampa came in at number 2 at 29%. And Washington, 11.1%. So, here we are. Let's take a look at this. What's the lowest one out there? 11.1% at Washington. So every one of the 20 metros has had double-digit increases, I think, for the past few months as well. So when you're looking at a 11.1 to a 32.2, so that's a lot of home price appreciation that's happening. We know the reasons for that. It's low interest rates, it's low inventory, it's bidding wars, etc. But this is from November. So once December hits, we do see a typical slowdown with respect to home price activity. I know that some of the other reports have talked about it's been a brisk winter for buying because if people want homes, they got to get them no matter what. Normally you have slowdown Thanksgiving, Christmas time, January, and you see everything picks up in the spring, etc. So like cyclical home buying periods, right? Also depending on location where you are in the country, etc. But I don't know if we're going to see that anymore. I think it might just be a constant from now on. So we need inventory. So we need to get the hands of distressed properties. We need to build more properties. We need a lot of things that we can do to basically satisfy the need for housing. So the economy, population grows. They got to live someplace, right? People are relocating all over the place now, shifting locations. We'll talk about that in future video predictions as well too. But really, we're peaking now. Like we really can't peak. Like we've peaked. We've bubbled up. And if we start to see some slowdown, that's what we're all looking forward to. So that's really, we have to see it. It's got to happen at some point in time. As I mentioned, we're not yet seeing any material distress come on the market to affect prices and inventory at this point in time. So when that starts to happen, that's where I think we'll start to at least see some relief from these high price points. All right. So as I mentioned, there's two housing markets in play right now. We have the mainstream talked about housing narrative retail market and the shadow inventory. The shadow inventory is all the stuff under the radar, off market, pre-foreclosure, distress, probate, estates, vacancies, out-of-state owners, all that type of stuff that's going on, tax deeds, and the foreclosure market. So a lot of that, is not, coming to the surface. It usually doesn't come to the surface unless it's held to the surface by specific people who are involved in that activity. So that's why, there's stuff there. So as much as, I guess what I'm looking for is don't think that you're never going to buy a house that's cheaper. Eventually, all that has to rise, to the top and integrate itself into the retail marketplace. It's just a matter of timing and actually getting it up there, which that's what people like me kind of do. So anyway, again, two markets play. Just don't be surprised of what you hear going on there. It's manipulated. It's being controlled. All right, so last couple slides, just waiting for it to cycle through. Obviously, this is a recently closed short sale back in our neighborhood here or in our area. Realize that this kind of debunks what people talk about in mainstream media. Yeah, you know what? There is homes that are underwater. There are homes that are distressed. And if you actually know what you're doing, you have the right system, you can actually get stuff, okay, like this. So this was vacant home facing imminent foreclosure sale. We had the foreclosure sale stopped. Total mortgage balance owed all in was $340. We negotiated $172 purchase price. That's a 49% discount off the mortgage. The ARV is about $350 based on Zillow. I mean, the range I think goes from like $330 to $375. Yeah, the home does need some work, but it doesn't need $170,000 worth of work. All right, so there's good equity there and it also has a new roof and things like that. So just a circumstance that wasn't good for the homeowner. But in the end, the whole point is that this is possible. It's possible because we know what we're doing and we know how to push this the right way. All right. If this was listed and taken care of by a vanilla real estate agent, this would have sold for $310,000, not $172,000. That's the difference, guys. Here, so that's why you want to work with me. All right. So as I mentioned, I'm doing some projects right now. So build to rent and build to flip. So build to rent is building brand new from scratch. We know what we're doing. We've got the builders who can help us at investor type pricing. Build to flip is the same thing. We'll just resell it at the end here based on where the market goes. I can't see how two of those are a bad scene. Where we are in the Tampa Bay market here, we had the number one rental appreciation from 2020 to 2021. Zillow has also said Tampa is going to be the hottest metro market in 2022, and we have people moving here from Northeast, from the Midwest, from the West Coast, internationally, the whole bit. Lots coming down to our area, and it's improving and it's growing, and a lot of tech is coming here and stuff. So it's a great opportunity. I have obviously a new program called Distressed Deal Architect. Basically, it's going to go over things like foreclosure, short sales, tax deed, code violation, stuff like that. So, and that's more of an entry level program. If you want to get involved, let me know. And of course, I have my advanced short sale program, which is really where people should be focusing because that's where the opportunities are right now. So drop me a line if you want to talk more about that. All right, guys, that's the scoop here. I'll tell you how to engage the distressed housing market. Just connect with me at randy@luxuryshortsales.com. So again, thank you for the views. Thank you for the likes and comments. Please share the video with your family and friends. Subscribe if you're not a subscriber. Reach out to me if you want more information, and we'll start to move this forward in 2022, where we're going to have a lot of fun. All right, guys. Talk to you soon.